So this chapter is going to discuss, really in this class for the first time, a financial statement called the Statement of Cash Flows. We did not go over it in the beginning chapter or two because we were really focused more on the income statement and the balance sheet. And that's where I wanted to focus our time. The Statement of Cash Flows is just like it says. It shows the cash that comes in and the cash that goes out. It doesn't have anything to do with your net income because we know net income is on an accrual basis. You've earned it, but you haven't necessarily received it. But companies can't survive without enough cash to pay their bills. So this financial statement predominantly helps investors see, do they have enough cash to handle their current bills? So that's what we're going to talk about, and the primary focus on this chapter is going to be to learn how to construct a statement of cash flows. Okay? So the statement of cash flows shows how a company operates, invests, and finances various activities, that how those various activities have affected cash during a period. It helps understand if cash has increased or decreased during the period and why. Cash is defined as using cash and what we call cash equivalents. Equivalents are investments that be converted into cash within 90 days or less. These equivalents would be money market accounts, short-term corporate notes, treasury bills, and treasury bills. So those are items that technically are not considered cash. They're cash equivalents because the cash isn't right on hand, but it can be on hand within 90 days. A company that invests in cash equivalents to earn interest would otherwise be temporarily idle. So think of this. If a company has $2 million sitting in cash in their bank, that's not really a smart use of money. It's better for a company to put it into a short-term investment to make money. Now, it's a very liquid investment. T-bills, treasury bonds, money markets, you can get at it pretty quickly, and it's liquid, but usually the reason you get that interest rate is because you're holding it away from you for a period of time. Cash equivalents are not short-term investments. Short-term investments, also known as marketable securities, are those items which can be invested for a company, but usually those have a maturity of greater than 90 days, greater than 3 months. So when we do purchase marketable securities, when we purchase them, we're using cash to purchase them. So that would be what's called a cash outflow. And when we sell marketable securities, we're gaining money. Think about it. When you sell a marketable security, you no longer have that asset. So that marketable security decreases, and what increases? Cash. Transfers between cash accounts and cash equivalents are not going to be treated as cash inflows or cash outflows. For our purposes, they're going to be the same thing. They're cash. Why do we need a statement of cash flows? It gives us that information about a company's receipts coming in and a company's payments, cash payments during a period in time. Some information about those activities can be assumed from other financial statements, but this cash flow statement summarizes all the cash received and all the cash going out. Management uses it to see how liquid they are, to see if they can pay dividends, and to see if they look at it to make decisions on investments and the need to finance. If cash flows are tight and they're not receiving the cash they need, it may help a company decide we maybe need to borrow some money so we can pay our bills. Make sense? They can be doing well from an income side, but remember, income means we earned it. We didn't necessarily receive the cash yet. Does that make sense, the difference? Yes? Investors and creditors want to know about this cash flow statement so they can see how companies manage their cash. Do they have positive cash flows? Can they pay their debts when they come due? And can they pay dividends and interest? And then it also allows them to see if they need loans outstanding, if they need to create some loans. Now, the cash flow statement is broken down into 3 types of activities. All companies perform 3 types of activities. One activity is called operating. This involves the reason a company is in business is for a certain operation, to conduct sales. Target, the main reason that company is in business is to sell merchandise. So the operating activities involve the cash monies coming in and going out from activities that determine their net income. So sales and cost of goods sold, or maybe inventory that's still on hand, and all the bills that are being paid. Cash inflows include cash receipts from the sale of goods, cash receipts from the sale of trading securities, the marketable securities that companies may buy and then sell to make profit with that money on hand. Interest received on loans and dividends received on investments. So those are all monies coming in. Monies going out would be cash payments for wages, inventory, expenses, interest, and taxes, purchasing the securities, trading securities. So primarily, operating activities include monies coming in from sales, from monies on investing, such as interest sitting there, dividends, and selling securities. The way money goes out is to pay the bills and to pay, purchase any securities on hand. Those are operating activities. Investing activities involve the acquisition and sale of property, plant, and equipment, and other long-term assets that include not marketable securities, but long-term investments. Okay? Those items that are going to be on the books for way over a year. Purchasing a new building that they're going to use would be property. Purchasing equipment that's going to last more than a year is part of investing. In long-term investments, that's how they plan for the future. Investing activities. The money that comes from investing activities include selling marketable securities other than trading securities that are for long term. Selling long-term assets, collecting on loans, because if you think about it, loans basically are a part of investing. When they go and take out a loan, that is a manner in which they're financing their business, or investing, excuse me. Collecting on loans, which would mean if they have loans outstanding and then they're being paid off, they're receiving money for those loans. Cash outflows are cash that's being used to purchase securities and assets, cash lent to borrowers. So we've got the operating activities, we've got the investing activities, and this one is the financing activities. How do they receive money? They're going to receive money from stockholders and from creditors. Inflows would be selling stock, borrowing money. Think about it. When you borrow money, you receive cash. Your cash increases and your liability increases. Cash outflows include paying back loans and paying dividends to the shareholders, and treasury stock. Think about it. When a company buys back treasury stock or sells treasury stock, that's a manner in which they're financing the company. Okay? Repayments of accounts payable or accrued liabilities are not considered repayments of loans and are classified as cash outflows from operating activities. Accounts payable usually occurs because we purchase supplies on credit. Okay? Or salaries payable means those salaries have occurred, we just haven't paid the bills yet. Okay? It's very short term. This PowerPoint slide here shows you what a statement of cash flows looks like. There are two manners in which we create a statement of cash flows. This manner starts with the net income. And then from the net income, it creates various adjustments for operating activities first. Remember, operating activities for the reason a company's in business. Then from there, it goes to the next place, investing activities, how they use their money to increase the company. And then after that, financing activities. So the difference between all of those is going to show at the end of the year an increase in cash or a decrease in cash. So this pretty much is a accumulation or culmination of all the things we talked about. As far as when we're dealing with operating activities, the monies that come in relate to selling goods or services, receiving money from interest we made on our bank account or dividends on certain short-term investments, and then also from selling trading securities, marketable securities that are short-term. What we pay out will be salaries, inventory, expenses, interest, taxes, and purchasing marketable securities. Then investing activities, the monies that come in will be from selling our property, plant, and equipment and long-term assets, from selling our trading securities, and from collecting on loans that we have lent other borrowers. Cash outflows related to investing is purchasing property, plant, and equipment, purchasing short-term trading securities, and making loans to people. And then financing is money's coming in from selling stock or from issuing debt. And then money's going out to reacquire stock, which is treasury stock, or to repay debt, or to pay dividends. So each of these activities is broken into specific events that occur with each one of those activities. So what I want to do real quick is go through a problem. Okay? What page would Oh, how do I? No, that's the one I want. Okay. Sorry about that, guys. This is kind of a new format, and I used to be able to just jump to a page, and I'm having a hard time seeing how to do that. Okay, here we go. Let's look at SE1. The list that follows itemizes Alpha Pro Corporation's transactions. We are going to take these and decide if it's an operating activity, an investing activity, a financing activity, a non-cash transaction, or none of the above. Okay? So the first one is sold land. What would selling land be? You're guessing an investing activity? What do you guys think? Not really land unless it was part of property, plant, and equipment. Do you know what I'm saying? If it was part of the operations of a company, then it would be. But that does sound more like sold land would be more of an investing activity because generally they sell asset or, property, plant, and equipment. So sold land would be an investing activity. What would number 2 be? Declared and paid a cash dividend. Perfect. Financing activity. Next, paid interest. A, operating activities. Issued common stock for plant assets. Kind of tricking you a little on there. They issued common stock, right? Financing. Issued preferred stock. Financing. Borrowed cash on a bank loan. Borrowed cash on a bank loan. C, financing. Borrowing cash on a bank loan. If you go back and we look at our PowerPoint slide, and we go back to this one, current slide. We receive money from issuing debt, and we have outflows of money from paying debt. So a bank loan is basically debt. Make sense? Down here it's financing from the issuance of debt. Financing. Investing is collecting loans. Investing means that I have money and a board of directors needs to borrow $100,000 from the company at a 9% interest rate. So the company lends a board of director money. That's their way of investing in their assets. Financing would be the company needs money, so they go and take out a loan. See the difference? In one, we're lending money, but we're getting interest received on it, so we're investing. This would be to give them money. That would be to make a loan. And then when the board of directors pays us back, we would be collecting the loans. Does that make sense, guys? Okay. In the financial statements, we have notes to the financial statements. Companies usually engage in different types of investing and financing transactions. These transactions involve only long-term assets or liabilities or stockholders' equity. Although non-cash transactions represent significant investing and financing activities, they're not really part of the statement of cash flows because they don't affect current cash inflows and current cash outflows. But since they're going to affect future cash flows, we're required to state and disclose it in the financial statements. Although it won't affect the cash flows of this period, we still need to let them know what's going on with those long-term investments. Now here's the crux of what we're going to do. There's two methods in creating a statement of cash flows. One is called the direct method and one's called the indirect method. The direct method converts each item on the income statement from the accrual basis to the cash basis. So as you see here, the operating activity section of the statement of cash flows using the direct method takes the income statement and then just shows money that came in from sales, money that came in from interest, and then we show payments for inventory, for operating expenses, for interest payments, and for income taxes. Then that's under the direct method. It's going line item by line item on the income statement. The indirect method is done a little different. In the indirect method, we start with net income. It lists only the items necessary to convert net income to cash flows from operations. So think about it. Net income includes some items that we really don't use cash for. Depreciation. Think about it. Depreciation shows the wear and tear on assets. We didn't necessarily purchase those assets this year, but we show a depreciation expense to help lower our net income, don't we? So there are certain what we call non-cash expenses that hit the income statement but really didn't have a cash ramification in this year. So we're going to add back non-cash expenses, and then we're going to add back or subtract changes in current assets and current liabilities. So for example, if at the beginning of the year we had accounts payable of $200 and at the end of the year the accounts payable was $1,000, we're going to convert that liability into cash, okay? In the same respect, accounts receivable. If we had accounts receivable at the start of the year at $200, and then at the end of the year it's $2,000, that's going to affect our cash. So we're going to use an indirect method to arrive at our cash based on net income. Then we're going to add or subtract those various items. The indirect method does not require the conversion of each item on the income statement. It only lists those necessary to convert income to cash flows. Indirect method is usually the most common method you're going to see used. So let's look at a problem. Okay? Let's go to SE2. Stewart Construction Corporation had a net income of $16,500 during 2014. In that year, the company had depreciation expense of $7,000. Accounts receivable increased by $5,500, and accounts payable increased by $2,500. Those were the company's only current assets and current liabilities. We're going to use the indirect method to determine the net cash flows from operating activities. So as you see here, we're going to start with net income. So as you see, we're going to start with cash flows from operating activities. We start with our net income of $16,500. Then we are going to, as you see here, adjustments to reconcile net income to net cash flows from operating activities. The depreciation that we took on the tax return decreased our net income, but we really didn't use cash for depreciation. So we're going to add back depreciation because we didn't use cash to it. And again, remember, we're going to take our net income and adjust transactions to reflect our cash. So if our net income shows $16,500, the depreciation we took on the income statement, we're going to add back to arrive at our cash. $7,000, we're going to add back to our net income. Now, think about this. When we increase our accounts receivable, we went from a smaller amount at the beginning of the year, and then at the end of the year, our account grew. That accounts receivable is shown as sales, isn't it? Right? It's shown as sales, but it's money we haven't received yet, is it? So when our accounts receivable increases, then the increase in the accounts receivable shows greater sales, but we haven't gotten them yet. So we need to reduce our net income by the increase in our accounts receivable. Because if you think about it, if accounts receivable have increased, then that shows we have sales related to accounts receivable. We've sold items, but we haven't received the cash yet. Since that accounts receivable increases, we ultimately need to reduce our net income to adjust for those sales that we recorded but we don't have in cash. Now, the opposite is true with accounts payable. With accounts payable, if accounts payable increases, then that means we owe more money, right? We owe more money. So an increase in accounts payable means that we have taken write-offs or reduced our net income by items we have not yet paid for. So in order to adjust our net income accordingly to cash, we're going to increase or add back to our net income our increase in accounts payable. So looking at this, our net income, and then we add back our depreciation, we add back the increase in accounts payable, and we subtract our increase in accounts receivable to arrive at our net cash flows from operating activities. Think of it this way. Always think of net income. If we have an increase of accounts receivable, then basically what that means is we had more sales, but we haven't collected on those sales yet. Okay? And the opposite is always think of how this affects net income. Isn't that weird, the color of this? When our net income has increased as a result of more sales on credit, we have a greater net income, but we didn't get the money for it yet. So to adjust our net income to cash, we'd have to reduce those sales as a result of accounts receivable. In the same respect, when we paid out a bunch of expenses on accounts payable, but we didn't use the cash, we have a lesser net income because we show expenses on things we still haven't paid for yet. It's on an accounts payable. We debited expense, we credited our liability. So since in that respect, we lowered our net income as a result of increasing our payables, we have to add those expenses that we haven't paid for yet back to our net income. We're going to work on a couple more, okay? Let's do SE3. It doesn't? Okay. Let me do this. Let me pull up an Excel. Whoops. We're always trying to bring it back to cash. So let's look at this, guys. Let's make it look like this. What if we have sales from cash, 100,000, okay? And then we have payments in cash for expenses, 70,000. And we have net income of 30. Okay? In this case, our net income is going to be the same as our cash flows, isn't it, on our operating activities, right? Let's take this exact thing And now let's add something to it. Let's say, so this is going to be cash flows equal net income. Okay? Let's take this and add something. Sales on credit, $30,000. So our net income is really $60,000 here, right? Sales on cash, $100, sales on credit, $30, payments and cash expenses, $70. So our net income really is $60,000, isn't it? Right? Under the indirect method, we'll show our net income of $60. And then we're going to say if these sales on credit are at $30, that means at the end of the year we have $30,000 in accounts receivable, right? Because we haven't collected the money yet, right? So our accounts receivable increased $30,000. So if we show an increase, if we show an increase in accounts receivable, if we minus $30,000 because our accounts receivable increased, cash flows from operating would be $30, just like here. Okay? It showed we had $60,000 of net income, but $30,000 of this money was due to sales on credit. Remember, our goal here is to try to figure out the cash changes during the period. Not the net income, but how much cash exchanged hands during the period. Let's take this and add something else to it. What if we show payments in cash of $70 and then payments on credit $20? Our net income really would be $40,000 now, right? You get what I'm saying? So if our net income here is $40, and then we want to adjust to our cash. Our sales on credit were $30,000, so our increase in accounts receivable we have to subtract. Our increase in our accounts payable, we need to add 20. The difference, cash, 30. You see how it's going to be the same as over here? But whenever we do things without cash, we need to adjust it to come up with what really the cash is that exchanged hands during the period. Does that make sense? Here's another one, guys. What if we have sales from cash, payments and cash expense, and what if we have depreciation of 20, which means our net income is really 10? Okay? Well, to come up with what our cash is, we start with our net income of 10, and then we have to add back non-cash expenses. Depreciation is a non-cash expense. We don't use cash to record depreciation. Depreciation is just showing use of that asset over time. So if we add non-cash expenses, then our cash flows from operating would be 30. See how we still keep going back to that same number again and again? Because we're reflecting those items that didn't involve cash. Let's go over another problem. SE3. During 2014, Kupalo Corporation had a net income of $144,000. Included on its income statement was depreciation of $16,000 and amortization expense of $1,800. During the year, accounts receivable decreased by $8,200. Inventories increased by $5,400. Prepaid expenses decreased by $1,000. Accounts payable decreased by $14,000. And accrued liabilities decreased by $1,700. Use the indirect method to determine net cash flows from operating activities. So think about this. If our net income of $144 includes depreciation expense of $16, that reduced our net income, but it didn't utilize cash to reduce it. So to take our net income to figure out our cash, we're going to add back that depreciation because it didn't involve cash. And our goal here is to come up with our cash. Our amortization expense of $1,800 doesn't include cash. It's basically an intangible asset we're amortizing, right? So we'll add back that $1,800 to come up with our cash. If accounts receivable decreased by $8,200, think about this. That means we brought in cash during the year. We brought in cash. So when accounts receivable increases, we subtract that amount. When accounts receivable decreases, we add it to our net income. When inventories increase by $5,400, we used cash to buy those inventory. So we need to subtract when inventories increase. Think about like accounts receivable increase, we subtract. It's an asset. When inventories increase, we subtract. When accrued liabilities increase, we add. When accrued liabilities decrease, we subtract. The best way to learn this is to make yourself a cheat sheet. And make a cheat sheet to show what you add or what you subtract based on what happens to those assets. Does that make sense? Let's go back and look at SE3. The net income was $144,000. So the first thing we're going to do is start cash flows from operating. We're going to start with net income of $144,000. Then it says adjustments to reconcile net income to cash. Depreciation reduces net income, but we don't use cash to do it. So we're going to add that money back because we're trying to determine our cash based on our net income. If depreciation we took reduces our net income, but we didn't use cash, we're going to add that figure back. Depreciation, $16,000 gets added back. Amortization's the same thing. We use that amortization expense to decrease our net income. But we didn't need cash to have that expense, so we're going to add back that $1,800 to net income. Then, when we look at our changes in our current assets and our current liabilities, If we increase an asset from the first of the year to the end of the year, we're going to subtract. When we decrease an asset, we're going to add it back. The opposite is true for liabilities. When we increase a liability, we're going to add it. When we decrease a liability, we're going to subtract it. Think of this why. If we had liabilities at the beginning of the year of 10,000 and at the end of the year they're at 2, how do we get that down from 10 to 2? Cash. We used cash to reduce that liability. So we need to adjust for that cash we use that doesn't necessarily show up in the income statement. Okay? So as you see here, when we decrease an accounts receivable, we add to it. When we increase an inventory, we subtract. When we decrease a prepaid expense, that's an asset, isn't it? It's just like decreasing accounts receivable. When we decrease a prepaid expense, we add to it. When we decrease an accounts payable, we subtract because we used cash to decrease that accounts payable. When we decrease an accrued liability, we're going to subtract from it. I'll let you sit here a minute.